Friday's $20 billion crypto market meltdown. A Bitwise portfolio manager's postmortem analysis. Jonathan Mann outlines a $20 billion liquidation day, long-tail air pockets, and a positioning reset that left markets on different footing by Saturday. Friday's sell-off triggered what Bitwise portfolio manager Jonathan Mann called the worst liquidation event in crypto history, with more than $20 billion wiped out as liquidity vanished and forced deleveraging took hold. In an article on X published Saturday, Perpetual futures, perps in trading shorthand, are cash-settled contracts with no expiry that mirror spot via funding payments, not delivery. Profits and losses net against a shared margin pool, which is why, in stress, venues may need to reallocate exposure quickly to keep books balanced. Mann, who is the lead portfolio manager of the Bitwise Multi-Strategy Alpha Fund, said Bitcoin fell 13% from peak to trough in a single hour, while losses in long-tail tokens were far steeper. He added that Atom fell to virtually zero on some venues before rebounding. He estimated roughly $65 billion in open interest was erased, resetting positioning to levels last seen in July. The headline numbers, he argued, mattered less than the plumbing. When uncertainty spikes, liquidity providers widen quotes or step back to manage inventory and capital. Organic liquidations stop clearing at bankruptcy prices, and venues turn to emergency tools. According to Mann, exchanges in that situation leaned on safety valves. He said auto-deleveraging kicked in at some venues, forcibly closing part of profitable counterpositions when there was not enough cash on the losing side to pay winners. He also pointed to liquidity vaults that absorbed distressed flow. Hyperliquid's HLP had an extremely profitable day, he said, buying at deep discounts and selling into spikes. Mann said centralized venues saw the most dramatic dislocations as order books thinned, which is why long-tail tokens broke harder than Bitcoin and Ether. By contrast, he said DeFi liquidations were muted for two reasons. Major lending protocols tend to accept blue-chip collateral such as BTC and ETH, and Aave and Morpho hard-coded USD's price to $1, limiting cascade risk. Although USD remains solvent, he said it traded around 65 cents on centralized exchanges amid illiquidity, leaving users who posted it as margin on those venues vulnerable to liquidation. Beyond directional traders, Mann highlighted hidden exposures for market-neutral funds. He said the real risks on days like Friday are operational, algorithms running, exchanges staying up, accurate marks, the ability to move margin and execute hedges on time. He checked in with several managers who reported they were fine, but said he would not be surprised if some C-tier trading teams got carried out. Mann also described unusually wide dispersion across venues, citing $300 plus spreads at times between Binance and Hyperliquid on ETH/USD. Prices recovered from extreme lows, he said, and positioning flushes created opportunities for traders with dry powder. Mann also mentioned that with open interest down sharply, markets entered the weekend on firmer footing than the day before.